Is Micron Technology currently flashing, a massive, undeniable sell signal wrapped in a falling technical trend? Or is it a surprisingly undervalued strong buy that is just like screaming to be added to your portfolio before the next leg up?
That is the ultimate market paradox we're seeing right now. I mean, you look at the technical momentum and you see these flashing red lights warning you to back away. But then you crack open the fundamentals and you see an absolute cash printing powerhouse.
Welcome to this deep dive. Today is April 20, 2026, and our mission today is to really cut through the mountain of noise.
Right, the conflicting financial data.
Exactly. The technical charts, the highly volatile market sentiment surrounding Micron Technology, ticker symbol MEU. We have a massive stack of sources today.
Oh, we really do. Everything from institutional research to insider trading logs.
Yeah, and we are going to break down exactly what is happening under the hood of one of the most hotly debated stocks on the market.
But, before we get into the heavy lifting with these numbers, we always have to be crystal clear with you. Everything we are discussing today is for educational and entertainment purposes only.
Right.
We're just having a natural human debate about the data, the mechanisms, and market psychology.
Correct.
This is strictly not financial advice.
Yeah, please, always do your own research. But to help us synthesize all this research we've gathered, I want to jump right into the center of the storm. We are looking at a stock that is riding what feels like an unprecedented wave of AI demand.
Unprecedented is the word.
Right. Yet when you look closely at the data, it's showing serious, almost glaring underlying contradictions.
Yeah, between its valuation, its actual trading momentum, and crucially, who is quietly heading for the exits.
Right. Because we have a company caught in this historic technological shift, the underlying business is evolving rapidly.
But the financial gravity of the stock market is starting to pull at it from completely different directions.
Okay, well, let's unpack this, because before we can even begin to debate if the stock is a value trap today, we have to understand the sheer, breathtaking scale of its recent financial explosion.
We really have to talk about how it got to this price in the first place.
Exactly. Let's look at the 52-week run. We're talking about a stock that rocketed from a 52-week low of $65.65.
Which wasn't that long ago.
No. Going on a monstrous run all the way up to a March 2026 peak of $471.34.
It is exactly the kind of chart movement that forces institutional analysts to completely recalibrate how they view a company's entire business model.
And just to ground us in the present reality, the latest quote has it currently sitting at $448.42.
Right.
That is following a 1.46% decline in the most recent trading session, and it's hovering right around $447.80 after hours.
So it's pulled back a bit from that 471 peak.
Yeah, but it's still operating in the stratosphere compared to where it was just a year ago. So what exactly drove this?
Well, to understand the ascent, you have to look at the trailing 12-month or TTM financials.
Right.
This wasn't just, speculation or hype.
Right.
It was fueled by an incredible surge in cold, hard cash. If we look at the income statement, total revenue hit an astounding $58.12 billion.
Wow.
Yeah. And turning to the balance sheet, in Q2 of 2026 alone, we saw an 18.07% growth in assets.
That's huge for a hardware company.
Exactly. But what is truly making Wall Street's jaw drop right now is the profitability. Gross margins are currently sitting at 58.44%.
Hang on, I have to stop you there.
Sure.
Because I know a little bit about the semiconductor space, and memory chips, which is what Micron makes, are historically known for being a brutal, cyclical commodity.
Very cyclical.
Right. When everyone builds memory, prices crash and companies bleed money. How on earth is a hardware company manufacturing memory chips pulling down almost 60% gross margins? That sounds like a software company's margin.
That is the exact right question to ask. And it really comes down to the specific mechanism of what they are selling right now.
Okay.
Because they aren't just stamping out basic memory for cheap laptops anymore. They are manufacturing high bandwidth memory, or HBM. And the manufacturing process for HBM is, honestly, punishingly difficult.
How so?
Well, they literally take multiple individual memory chips, shave them down to a microscopic thinness, and stack them vertically, kind of like a skyscraper.
Oh, wow.
Yeah, and then they have to drill microscopic pathways called through-silicon vias down through the entire stack to connect them.
That sounds insanely delicate.
It is. If even one layer misaligns by a fraction of a millimeter during that baking process, the entire stack goes in the trash.
Wow.
So the yield, the percentage of usable chips they actually get out of a batch is incredibly low because it's so hard to make. That difficulty creates massive scarcity.
I see. So, I like to think about it like this. Imagine you are building $1 million high-performance V8 engine. And that engine is the massive AI processor, right? The GPU that everyone is buying. But a giant engine is completely useless if you can't pump gasoline into it fast enough.
That's a great point.
High bandwidth memory is the fuel injector for the AI revolution. You can have the best AI processor in the world, but if Micron's memory isn't there to pump massive data sets into it at lightning speed, the processor literally starves.
That is a phenomenal way to look at it. And because they own the fuel injector technology that is incredibly hard to build, they have immense pricing power.
Which explains the margins.
Exactly. And the bottom line proves it. Net income is sitting at a massive $24.11 billion.
Incredible.
Diluted earnings per share EPS is at $21.19. They have beaten consensus estimates for the last 4 quarters straight.
Or quarters.
Right. And if we look at the cash flow statement, operating income is $28.13 billion, which has left them with a significantly strengthened net cash position.
Okay, so if they're printing that much cash and they own the proprietary fuel injectors for the greatest technological boom since the internet, why is the stock stumbling?
Well, that's the rub.
Yeah, why is the trend shifting? Let's get into the technical analysis because the momentum is clearly not matching the fundamental cheerleading. Break down the actual chart for us.
Yeah, so while the long-term trend is undeniably bullish, the short-term reality is that the stock is displaying real weakness.
We're seeing a pullback.
Right, we are currently witnessing a pullback from that March peak. Right now, there's an immediate resistance zone, a ceiling of selling pressure just above the current price. It's sitting between $455.08 and $465.67.
So every time it tries to rally into that zone, sellers push it back down.
Exactly.
And what about the floor? Where are the safety nets if this falling trend accelerates?
We have strong support down at $379.49, which aligns perfectly with the longer-term weekly trend line. If that level fails to hold, the next major structural floor is significantly lower, down at $335.09.
Right. So we're basically sandwiched between a ceiling at roughly 465 and a floor at 379. But let's look at the momentum indicators because this is where my alarm bells really start ringing. The RSI, the Relative Strength Index, is sitting at 62.61. That tells us it's technically neutral, but it is definitely inching its way up toward overbought territory.
Yes, it is.
But it's the MASD that really caught my eye. The moving average convergence divergence is sitting at 14.65. And our sources are explicitly noting that this is generating short-term sell signals.
It definitely is.
So for the listener who doesn't stare at charts all day, what does that 14.65 actually mean in plain English?
Well, the number 14.65 itself isn't the crucial takeaway here. It's what the indicator is actually tracking. MASD measures the relationship between 2 different moving averages of the stock's price.
A fast one and a slow one, right?
Exactly. When the fast average crosses below the slow one, it's showing us the velocity of the buying pressure. Think of it like driving a car. The car might still be moving forward at a high speed.
But the driver just took their foot off the gas pedal.
Right. The acceleration is dropping, the momentum is visibly declining, which is why technical traders see that as a short-term sell signal.
And here's the part of the technicals I absolutely have to push back on. The current price is around $448, but it's 200-day simple moving average. The average price it has traded out over the last roughly 10 months is way down at $258.06.
That is a massive canyon.
It's insane. That is a nearly $200 gap between the current price and its historical average.
Yeah, it's huge.
If you stretch a rubber band 200 inches away from its anchor, eventually that tension is going to violently snap back. Doesn't gravity always win in technical analysis?
Wow.
I mean, how long can you defy that kind of historical average before a reversion to the mean drags this stock back down to 258?
That is the core of the technical anxiety. And you are entirely right that a gap of that magnitude relative to the 200-day moving average is a classic frothy signal.
The rubber band is stretched to its absolute breaking point.
It is. However, if we connect this to the bigger picture, when you have a structural paradigm shift in a technology like the sudden explosive need for AI servers, historical moving averages take time to catch up to the new reality.
So the AI enthusiasm can temporarily distort traditional technical gravity.
Exactly, it distorts it.
But the rubber band eventually has to snap.
It does. Reversion to the mean is a powerful, almost inevitable force. But the debate isn't whether it will revert. The debate is whether the stock crashes down to meet the $258 average, or if the stock simply trades sideways for 6 months while the moving average slowly rises to catch up to the new price.
Ah, I see. So, with the technicals showing momentum exhaustion and that massive, terrifying gap to the moving average, we arrive at the central debate. We have to look at the ratings and the signals.
Right.
Is this a temporary dip in an undervalued gem, or are we staring at a dangerously overvalued value trap? Let's look at the analyst consensus.
The disconnect between the technical warnings and Wall Street sentiment is honestly jarring. Wall Street analysts are practically euphoric right now.
They really are. We are looking at a staggering 25 buy ratings, 3 holds, and absolutely 0 sells.
Zero.
Not a single strong sell or even a mild sell. The average price target they've set for the short-term outlook is $543.20, and the high target, $700.
Which implies a massive runway from the current 448 level, and they justify this with the undervalued argument. If you look at Micron's price-to-earnings, or PE ratio, it's currently sitting at 21.17x.
Which honestly doesn't sound very high for a booming tech company.
Especially when you compare it to the broader semiconductor industry average, which is sitting way up at 45.2x.
Oh, wow.
So from that simplistic PE perspective, Micron looks like a massive bargain. You are getting incredible world-class earnings for half the premium of the rest of the sector. It looks deeply undervalued.
Right. But I'm looking at our research, and here's where it gets really interesting. Here's where the trap argument comes in.
Let's hear it.
We have this strong buy chorus from analysts, but then you look at discounted cash flow, or DCF models, and some of these DCF models are screaming that the stock is actually 70.5% overvalued right now.
Which is a stark contrast.
Very. Can you explain to the listener what a DCF model is doing differently than a simple PE ratio, and why it's flashing such a negative signal?
Absolutely. A discounted cash flow model is essentially a financial reality check. Instead of just looking at what the company earned this year, a DCF model attempts to project every single dollar of free cash flow the company will generate from now until the end of time.
Wow, okay.
Then it discounts that massive pile of future money back to what it is mathematically worth today, adjusting for risk and the time value of money.
So it's heavily dependent on long-term terminal growth assumptions.
Exactly. A PE of 21 only looks cheap if you assume those 60% gross margins and record-breaking earnings are going to last forever.
Right. Which historically they don't.
The DCF models are looking at the underlying mechanics of the semiconductor industry. They assume that eventually, competitors like Samsung and SK Hynix will build more factories, they will master the HBM stacking process, supply will catch up with demand, and those 60% margins will compress back down to earth.
Right.
If earnings drop back to normal historical levels, paying 21 times peak cycle earnings is actually incredibly expensive. That is why it might be a trap.
And if you want to know who is taking that trap argument seriously, we just have to look at the smart money.
Who is actually buying and selling right now?
Exactly. Despite Wall Street analysts unanimously saying there are 0 reasons to sell, the latest SEC filings show that insiders at Micron have been aggressively selling their shares over the last 3 months at these record levels.
Very heavily.
Furthermore, the options market flow, the people placing leverage bets with real capital, is currently leaning moderately bearish. Why are the smart money insiders, the people who know the company best, heading for the exits if the analysts are so sure this thing is going to 700?
Well, this brings up the crucial difference in incentives. Analysts build their models based on the current sold-out capacity.
Yep.
They see the incredible numbers today and linearly project them forward.
Right.
Insiders, however, have lived through these hardware cycles before. They know the physical limitations of scaling these factories. When your stock is up nearly 7 times from its 52-week lows and your margins are at a historic 60%, you are breathing rare air.
Yeah.
Cashing out and securing generational wealth is simply rational human behavior for them, completely, regardless of what a junior analyst's spreadsheet says.
So we have an incredible fundamental setup colliding with terrifying technical and insider signals. Let's outline the ultimate bull versus bear cases. Give me the absolute best case recovery scenario. What is the bull case?
The bull case rests entirely on the idea that the underlying architecture of the world has permanently changed.
Okay.
It's the argument that this isn't just a hardware cycle, it is an infrastructural build-out on the scale of the early internet. Because the barriers to entry for manufacturing high-bandwidth memory are so extreme, remember the microscopic precision required we talked about?
Right, the stacking and drilling.
Exactly. Micron will maintain a pseudo-monopoly on high margins for years. In this best-case scenario, The current short-term weakness is just a brief consolidation. It's a healthy pause before it shatters that $465 resistance and marches directly toward that $543 target.
I can understand the logic there, but I have to play devil's advocate with the bear case. Let's talk downside risks and the worst case continuation lower, because there are two massive threats here. First, what happens if the capital expenditure, the billions of dollars required to build these highly complex AI chip fabrication plants, starts entirely outpacing the revenue growth?
It's a huge concern.
Right. The moment CapEx grows faster than revenue, those glorious 60% margins just collapse.
That is a massive structural risk.
And the second risk is geopolitical volatility. We are dealing with the ever-present looming threat of U.S. export controls on semiconductor technology. How exactly do those geopolitical controls destroy a stock's valuation?
It really comes down to the total addressable market. If the U.S. government decides that advanced AI memory chips are a matter of national security, they can implement export bans.
Right.
And those bans physically prevent Micron from selling their highest margin chips to massive global markets like China. Overnight, without any change to the company's internal operations, a huge percentage of their future projected revenue simply vanishes.
Wow.
If that happens, this recent pullback isn't a breather. It is the beginning of a long, painful slide right back down to meet that 200-day moving average of $258.
And this incredible tension between the bull and bear cases is exactly why retail traders, the everyday investors listening right now, so often get violently trapped. Walk me through the psychology of the retail trap here. Let's say I'm an everyday investor who just heard about the AI boom.
Right, so you log into your brokerage app, and what is the first thing you see?
I see a wall of 25 strong buy ratings.
Yep.
I see a high target of $700. And I see a chart history that went from $65 to $470. It looks like free money.
Right, so the fear of missing out kicks in. The retail investor buys in at the absolute peak, right around that 471 mark. But then the stock hits that technical resistance ceiling we discussed and starts to pull back to 448.
And suddenly my account is in the red.
Exactly. So now the retail trader starts digging deeper out of anxiety. They look at the declining MACD momentum. They read the news about massive insider selling.
And they see the DCF models warning it's 70% overvalued.
Right. The volatility shakes their confidence entirely. Panic sets in, and they end up selling their shares just to stop the pain.
Often selling right into those strong support levels around $379?
Yes. They lock in a massive crushing loss right before the institutional buyers step back in at the support level to buy the shares on the cheap.
It's a psychological meat grinder.
It really is.
Retail buys the hype at the top and sells the fear at the bottom, all while the insiders are quietly doing the exact opposite.
Which is why having a clear outlook, separating the short-term noise from the long-term perspective, is so vital here. In the short term, the stock is wrestling. It is highly volatile, caught between strong financial tailwinds and heavy technical resistance, flashing very mixed signals.
And in the long term, it comes down to a single question. Can the macro AI demand sustain those 60% gross margins, or is this just the peak of the greatest hardware cycle we've ever witnessed?
That is the fundamental mechanism that will dictate whether this chart eventually reads 700 or 250.
So what does this all mean for you listening right now? We've unpacked a massive amount of data today. On one hand, Micron is a fundamental powerhouse. They are generating billions in free cash flow, operating at near software-level margins.
Right.
And they manufacture the exact highly complex fuel injectors that the entire AI revolution desperately requires. But on the other hand, the stock is technically stretched to its absolute breaking point. It's trading almost $200 above its historical averages.
It's incredibly stretched.
And flashing glaring warning signs from both insider selling activity and long-term valuation models.
It truly is the irresistible force of fundamental momentum meeting the immovable object of technical gravity.
Which brings us back to my first question. Is this an undervalued buy, a volatile hold, or a dangerous value trap? That is where you come in. If you are watching or listening right now, I'm making it compulsory to get involved in this debate. Please take a second to like this video, subscribe to the YouTube channel, and leave a comment below with your feedback on today's analysis.
We really want to know your thoughts.
I want to know exactly how you are playing this. Are you siding with the 25 Wall Street analysts screaming buy, or are you siding with the company insiders who are quietly cashing out? Let us know in the comments.
It is the defining decision for any investor looking at the semiconductor space right now.
And I want to leave you with a final, slightly provocative thought to chew on. We've spent this entire deep dive hyper-focused on Micron's specific mechanisms today, but shouldn't we be looking at the broader neighborhood?
Oh, absolutely.
The next major catalyst for this entire market is the earnings report looming on June 24th, 2026. If we take these exact same discounted cash flow models and we apply these exact same stretched moving averages and insider selling patterns to the undisputed king of the sector, NVIDIA, might we discover that this entire AI sector isn't just a golden paradigm shift, but a massive, incredibly delicate bubble just waiting for a pin.
That is the million-dollar question.
Something to think about. Until next time, keep digging.